Today I talk to you about family trusts and whether investing through a family trust is a good idea in Australia, and also talk about the costs of running a family trust. Alright, let's get into the video. Hello everyone, I'm Rooshock, and on today's episode I'm going to be talking to you about should you invest in a family trust in Australia. So I'll be briefly touching on what a family trust is, the costs of a family trust, and who I think it is right for and who I don't think should be using a family trust when it comes to investing. Now obviously this is just general advice. You need to go do your own research and seek professional advice where needed, because everyone's situation is different and one piece of advice doesn't fit all. So I'll briefly touch on what a family trust is. So it's really just a structure that holds investments. So rather than investing in your own names or in joint names, you're investing in a trust name. So there's lots of different types of trusts, but today we're just going to really focus on a discretionary family trust. And so there's multiple reasons why people will invest in a structure that's not in their own name. So investing in a trust, or there is also companies, but it gives you different tax benefits potentially, different asset protection, and there's also then costs that come with it, which is the negative side to it. So obviously, as soon as people hear tax benefits, they just must assume that, oh, a trust must be a great idea, we should definitely do it. But you need to weigh up whether the benefits outweigh the costs. So the first thing that you need to address before deciding whether you're going to invest through a trust is what beneficiaries you're actually going to have available. So a beneficiary is someone who is a beneficiary to the trust income. So pretty much they can receive a distribution of whatever income that trust holds, and that becomes a part of their own taxable income. So a trust will have a taxable income. So say it might earn $40,000 and there's 4 beneficiaries, and you might have 3 of them get $5,000 each and the other beneficiary gets $25,000. So it doesn't have to be distributed equally. So as you can see straight away, that's where one of the tax benefit comes here, is you've got the ability to distribute profits as per the deed of the trust, but that may leave it pretty open-ended that it can be distributed differently each year. It doesn't have to be the same percentage each year to each beneficiary. So obviously when assessing whether a trust is right for you, you need to see what beneficiaries you're actually going to have available to you. The trust deed itself will outline who the beneficiaries can be, but this can be a little bit open-ended, so it could be your spouse, obviously, it could be parents, it could be children, it could be siblings, it just depends what's written into the deed. But you need to assess who have you actually got available to distribute profits to. So if you're just a couple and you've got no children, your parents aren't in a position to get distributions, then you need to weigh up, okay, we've only got 2 people to distribute profits to, what are our savings going to be versus the cost of running this trust? The other thing you need to consider is the taxable income levels of each beneficiary. So I'll get into this in more details, but if you've got 2 people that are on the same taxable income, all you're going to be doing is distributing profits in the same way that would be if they were held in just a joint names or in individual names and split approximately 50-50. Now there can be some huge benefits though, where say one person of a couple isn't working, or you've got adult children who aren't working, or you might have parents who aren't working. Suddenly the major difference in their individual taxable income levels will make the benefits of a trust much more beneficial to you. So I've touched a bit on the who there, but I want to go into more detail of who could be beneficiaries and some of the quick reasons and some of the things you need to consider. So obviously if you're in a couple, both partners of the couple will likely be beneficiaries to the trust. Now, obviously, like I said, you're going to have to take into account what the taxable income levels are. So you might have a wife who's working full-time and the husband may be working part-time because he may run a business on the side that's still growing. So you might have differing levels of taxable income there. Therefore, distributing beneficially through the trust, you may be able to balance up their taxable incomes a bit. Now, next you might have children you can distribute to, and this is where people get caught out. They think initially they can just distribute all their money from the trust to their children, but unfortunately you can do that, but they're going to pay a high rate of tax. So there's a maximum amount that you can distribute to children before they're going to pay a really high rate of tax. So currently you can only earn $416 of this type of income as an under 18. Otherwise, you'll be paying 45 cents to the dollar on all your income that you get distributed from a trust or earned through a bank account in interest. There are a few exceptions here, which I won't go into because we're just talking about trust distributions here. So that's really, unless you've got 15 kids, you're not really going to benefit huge amounts. You can distribute them that $416, but it's obviously not going to save you a huge amount of tax. It is going to save you a minimal amount of tax, but yeah, it's not going to be any huge tax savings like I think some people think is going to happen. One thing I do want to touch on when it comes to distributions to adult children is consider they may be studying. So one, they might be getting youth allowance or some kind of study income. But then you also got to consider if they've got HECS debts. If you're making a large distribution to them, potentially this may put them in a situation where they're having to start pay back HECS, and that's going to affect the cash flow benefits you've got here. So the next area you could distribute to is your parents. Now it's going to depend on what situation your parents are in. They may be not working at all, under retirement age, and therefore you can make use of that tax-free income that they can receive. But you've got to weigh it up though. If they're, say, getting a pension, is a distribution to them going to affect their pension? Or is the paperwork and the time that's going to take you because of this, is that going to really disadvantage some of those benefits you're going to get? This is where it starts to get a little bit more complex, and you might need to seek proper advice or do a lot of research into these areas, because you don't want to distribute to save some tax, but then they lose access to their pension, and therefore you've nulled the benefits that you're getting from the tax savings. So you always want to put yourself in the best position overall, not just in one aspect of finance. And then obviously depending on how your trust deed is set up, you may have siblings in it. So it does get complex the more people you're bringing in, purely because, like I said, if someone's receiving Centrelink benefits, you want to be careful when you're distributing profits to them that they don't get those cut. And that's not just pensions, it could be youth allowance or new start allowance, etc. So you've just got to be careful who you're distributing money to, depending on what else it could affect. There are other benefits of a trust though. So you might like the idea of the security that a trust has, depending on how it's set up. You might have trustee companies, etc. that might give you a bit of asset protection. That's a real in-depth area. So you definitely need to seek legal advice there when you're looking at a protection side of it. The other thing people do use trusts for is to pass down assets through a family. Again, it's a complex area. I'm not an expert in that. I'm not a lawyer. So you really need to get that proper legal advice if that's the reason you're setting up a trust. The other thing with the distribution side is it does give you flexibility. So right now it might not be beneficial to you to have that split of income, might just leave you in a similar position. But you might have that flexibility now if down the line one of the partners in a couple starts earning a lot more income, or one leaves their work to look after children at home and therefore has no income. It can give you that flexibility that you might not have if you held those assets in your personal names. So there's some of the benefits, but I want to talk about a couple of the cons quickly. So there's the costs, which I'll go into in more detail in a minute and weigh up some of the options you've got with costs and weigh it up versus the benefits. But obviously something like this is going to cost you. There's going to be upfront costs and potentially ongoing costs. So like I said, you need to weigh up the benefits versus the cost. The other thing is it's complex. As you can see from what I've just talked about, I've only just skimmed the surface of it, but it is a complex structure. So you've got to weigh up, do you want to spend the time or pay someone to work all this out for you and explain it to you? And also say you get sick and you've left it to your partner who might not be as interested in it. Do you want to lump them with the burden of having to work out all of this? Or the same as if unfortunately you were to pass away and both partners will pass away and it becomes something that the kids have to deal with. They're either going to have to work it all out themselves or they're going to have to pay money to get advice on it. Before I get into the costs of a trust, I would love for you to hit that like button. And if this is your first time here, make sure you hit that subscribe button, because I do more videos on personal finance, tax tips, and just talking about money in general. So it really helps me by hitting that like button, hitting that subscribe button, and leaving a comment down below. So let's now talk about some of the costs of setting up a trust and then kind of work out, is it worth it based on the benefits you might get from it. So as I said, you're going to have initial startup setup costs. So this will be the cost to actually establish the trust. So within this, you're going to have two parts. So first, you're going to have the actual legal cost of setting up a trust deed. Now, this is going to vary on depending on who you go through, but you're probably looking at that range of $160 to $200, just depending on how complex you make your trust, and it could skyrocket from there depending on what you want to write into the deed. But for a basic deed, I think that $160 to $200 mark is probably the baseline. Now this could get complex if you want to add a trustee company, because they're probably upwards of $600 now, and that's just for the actual company setup, and then they have different ongoing fees from there. But today we're really just going to focus on the trust side of it. Now the other thing you might have as a startup cost there is accounting or legal advice. So you may be paying someone to do this for you, and therefore you're going to have the advice fee of them actually giving you advice on whether it's beneficial to you. Plus, if they're actually doing the setup for you, they're probably going to have to pay them for that service as well. So that's something you got to factor in. This is really hard to estimate. This could be a couple $100 to thousands of dollars. So obviously get a quote on this before you go ahead and do it. And then ongoing, the good thing with a trust, you're not paying ASIC fees like you are with a company, but you're going to have ongoing either advice or accounting fees probably. So this is really hard to estimate. It's really going to depend on how your trust is structured and what you hold in that trust. So if you've got really simple investments, it's a really simple distribution that doesn't change much year to year, you might only be looking at a few $100s, but this could easily be in the thousands of dollars if you've got some complex investments in there, or if you're gonna have real changes in the beneficiary's taxable income, so you're gonna have to reevaluate each year on the best ways to distribute. So again, speak to your accountant, get some idea of what this cost is gonna be per year. So when you're doing a estimate of, is this gonna be beneficial for me? You've got an idea of what some of those ongoing costs are gonna be. And then you may have some other one-off costs if you're wanting changes to a deed or any major restructuring within that trust, or whether you're wanting to bring in trustee companies, etc. But obviously that stuff's gonna be a bit hard to know at the start because that stuff's more likely to change at a major life event, etc. So you may be able to write some of this into the deed initially. So some deeds will allow you to include future children you may have or grandchildren. But again, you need to get that legal advice so it's structured right. So hopefully it might save you some money down the track. So let's have a look at a bit of an example here. So we're going to use the example of it costing $1,000 to set up and $1,000 per year. These are just rough estimates, but it'll make it really easy to do some calculations. So let's assume the other benefits, for instance, asset protection, etc. You're saying they are equaling out to the complexity of it. So we're just going to purely look on a cost basis of tax savings versus cost to see if it would be beneficial to invest through a trust. So let's go with the first situation here where we've only got a husband and wife, and one earns 150 grand and the other one earns 50 grand. So we've just got two simple tax brackets here. So we've got one on a 37.5% tax bracket and the other one on a 32% tax bracket. So let's go with, say, a $15,000 taxable income for the trust. So we've got a distribution to make here. So if we were to have that in joint names or held in individual names as such, so it was going to be a complete 50-50 split, you would end up paying about $5,212.50 in tax. Now, if we have that in a trust, we can distribute how we want. So in this situation, we're likely to distribute all of that trust income to the person on the lower income. So now we can see that the tax payable for the trust income distributed in individual names would now be $4,875. So we've saved $337.50 by having the income held in a trust. Now, what we just spoke about before is costing us $1,000 a year to run this trust in accounting fees. So therefore, we're actually losing out by doing this. Now, obviously things could change with taxable incomes in the future, like we've talked about just before, but based on this, if you know that your situation is not likely to change at all, then it's not going to be worth it when it comes to tax savings for you. Now let's change this here. We might have a lot more investors. So now we're actually getting a $50,000 worth of taxable income for the trust. So let's have a look at this now. So now we've got $17,375 payable if this was just held in 50-50 names, because obviously we've still got those same taxable incomes as discussed earlier, and therefore the differing tax brackets. Now, if this was all held in a trust, we'd actually only pay $16,250. We'd save $1,125 by having that ability to flexible distribute. So this is where you might go, yeah, I'm gonna save more than what I'm gonna cost me in fees, so therefore I wanna go down this path because I'm hoping that distribution amount will continue to grow, and therefore those benefits will become larger as that income distributed becomes larger. Now, obviously, if we look at one of those situations, again, that $15,000 distribution, but now we've got a partner that doesn't work at all. So we're going to distribute that full amount to them. We're assuming they're getting no other benefits, Centrelink or family tax benefits that are going to be affected. So suddenly we're going to save that full amount of tax that we would have paid. So you can see how if you had adult children that weren't working, etc., and you've got more people to distribute for, there's definitely ability to save good money there, but it just depends on taxable incomes of your beneficiaries, what beneficiaries you've actually got, and then how much money you're actually going to have to distribute. One of the other things you got to really consider with a trust is if you already hold those assets in personal names, if you sell them now, you're going to have potential capital gains that you're going to have to pay, and that may reduce your actual asset value. So if you've got a $10,000 asset and it's going to cost you, say, $1,500 in capital gains, and then you're going to reinvest that in the trust, you may actually have less to invest then because you've had to pay a bit of tax on that. So that might still work out well for you, but it is something else you need to consider. So do I suggest investing in a trust? Like I said, every situation is going to be different. I think you've got to weigh up, are you doing it for the cost benefit or for the asset protection and flexibility benefit? If you're doing it for the asset protection and flexibility benefit, that's a really detailed, really complex. It's going to depend on your situation and why you're doing it. If that's something you're really interested in doing, it's likely that you're going to do it anyway because you're not too fussed about the small cost to this. If you're only doing it for the cost benefit, like I said, you need to weigh up who you're going to distribute to, what it's going to actually save you in tax, and is that going to be more than the fees that it's going to associate with. Today's question of the day is, do you invest through a trust, or is it something you're considering doing? I really hope that's been beneficial to people. I've got a few other videos talking about tax tips, etc. on my channel, so I'd love for you to check them out. Thank you for being here, and I'll talk to you soon.